Welcome to Capitalizing Your Life, the podcast that shows you how to take control of your money, build lasting wealth, and create financial freedom using the infinite banking concept. If you're ready to make your cash flow work for you instead of someone else, you're in the right place. Here's your host, Glenn Yaney.
Today, my guest is Trent Fortner with the Game Time Coaching Program. Welcome, Trent.
Thank you, Glenn. Honored to be here.
Yeah, I'm excited to have you. And I've definitely gone down the wormhole of looking you up. I know that you've mentored a lot of the big names in life insurance and really always love the dialogue you have in other podcasts. So I'm glad to have you on.
Well, thank you. I was introduced once in a meeting I went to a meeting with Brock to Justin Donald's event, Lifestyle Investor, and Garrett Gunderson was going to speak. And, I worked a lot with Garrett when he first got started. I was his mentor for a while, he and Michael Isom. And Justin introduced me as the OG, and I realized that really just meant old guy.
I mean, really, just hearing your experience with just on how far we've come and the conversation about it, it just really, I feel like that's been the thing that helped me understand the value of, life insurance.
Oh, good. Good.
So if you could, I guess, really tell us about kind of your business and what problem you're trying to solve.
It's a good question. So I've been in the financial business for almost 37 years. The last 18 and a half, I've been a coach to financial advisors in the U.S. and Canada. And what I do there is I try to help build, I would say habits, but build a site of abundance so that they can work with clients to best empower them to position all of their assets to work together, first of all, but to protect them, utilizing life insurance and trusts and other strategies that allow them to live a better life now. There's a phrase that I use quite often called, "We all live until we don't." And as advisors, a lot of people overlook that. And to me, the life policy, including the death benefit, becomes asset protection later in life. Now, later might be tomorrow. Later could be 30, 40, 50 years from now. But we have to manage our money, all of our assets, for our entire lifetime. You mentioned in a story earlier to me about the importance of liquidity.
Yeah.
What the problem that we're solving, the thing that you asked me about. Most consumers are taught to place their dollars on a regular basis into assets that they end up being locked out of. The reason they're locked out of them, the big three, which I call them the big three. I was taught to call them the big three: the banks, financial institutions like Wall Street, and the government teach us a set of rules to play by. Not rules they play by, but they teach us rules to play by that sound like it's an incentive for us, the consumer. But if we follow those rules the way they teach us to play, it's not about you winning as a consumer. It's about you just playing the game your entire life. And the longer the money is under the control of the other institutions, the less control, freedom, access, memories, experiences will you be able to create and live. To me, helping people be educated in that area so they can activate all resources that they have available is an incredible opportunity.
And that was really the thing that drawed me towards, infinite banking. And really, it's just like empowering people to take control of their financial system. And how much I followed the path of conventional finance, of accumulation, and really waiting for that one day that I'll get to use it and hoping that the market goes the right direction. And really, I learned as I started meeting more successful people, those weren't the rules that they were playing by. They were playing by how do they control the situation, where the capital is coming from. And really, that's the one thing that we're just trying to teach people.
Well, yesterday in my mastermind group, we had a conversation. I was reminding them, I'll remind you. So when you learned to play tic-tac-toe and someone was teaching you to play, who won that game?
I guess they would let the kid play or win. I don't know.
Yeah, at first, the way I learned, I was not winning from the people that were teaching me originally.
Oh, okay.
Now I
I
learned
let my daughter win.
Okay. So when we're first learning the game, the people that are teaching you to play, they're not really teaching you to win. It's the joy of the game, the excitement of the game, the time together.
Yeah.
And so, the first few times you play tic-tac-toe, you're probably not going to win unless somebody's letting you in and build up a little dopamine there, right? So you can continue to play. And then you might learn a strategy. And I think when you tie, they call it a cat or something like that. You put a C around it.
Yeah.
Well, the financial game's just like that. Everybody's learning to play from somebody else. Now, those that follow all the typical rules, that follow the way the traditional planning goes, is all you create are averages. Everyone becomes an average because everyone's doing the same thing. If we're going to be outstanding and if we're going to have control and if we're going to literally win, Garrett Gunderson and I have talked many times and taught many times, win first, then play the game.
Yep.
If we identify what that win is and we're real clear on what our wins are, each person has a different win. But if we're in control and we have a system where we can create protected, liquid, guaranteed dollars in our lifetime, then we don't have to worry about finding opportunity. It finds us because we have cash. We also find ways to be more certain. We can reduce the risk of investments because we have backup strategies, safety, redundancy. And the real cost of a lot of the decisions is it's not a lower rate of return or a tax or a fee. It's a combination of all those things. And so we got to find where dollars are being lost and then bring them back.
Yeah, definitely. I had this guy, he was about 23 years old, talking to me yesterday, or he's texting, asking me questions. And it's like all the things he was saying were like something that you would read on some Market Watch article where you're like, he's like, I want to buy a rental property, pay off all the debt, and then I'll buy another one. I was like, well, just know you're never going to have real estate if you do that. It's like, we have to figure out, you got to think about how valuable these dollars are that you're earning and put a value to it. So what you're doing is you're discounting your dollars when you give them to somebody else. We're trying to take back control even investing. And I love with Garrett Gunderson, how he talks with, when you put your money into an index fund, it's like you're funding someone else's dreams. So what are we trying to do here? We're trying to live our best life, but also be able to take advantage of opportunities that are more fulfilling in our own lives. And that's kind of been my whole motto with everyone that I talked to recently.
Well, it's a good motto to have. One of the things that we talk about a lot is that, you are your best asset and you need to protect that one first. Your ability to be creative, have the health to work, the ability to work, the ability to create those assets that will pay you. And what a lot of other people, if you go talk about that great index fund or whatever it is, I just got to ask a few questions. How do you feel about giving money to somebody you don't know? And you don't know what their true perspective is on it. And you don't really know how the game works at all. And if that's the case, that's the same as gambling.
Definitely. Yeah. So like, what is the biggest way, like for me, it's like, I'm new in the business. It's like, we talk about life insurance. You and I understand the value. How do you get people over the hurdle of dropping the life insurance bomb on somebody? It's like the one thing that it's like you tell them all the values and then you tell them it's life insurance and then they just want to go the other way.
I can answer a few things about that. First of all, I don't lead with the life insurance.
Yeah.
I lead with, where are you financially today? If today, and we sort of did this on our phone call, I said I didn't have directions to get to you on the podcast, right?
Yeah.
And so you sent me directions, but you had to know where to send them to. So if you're going to come meet me physically, I'm going to have to say, Glenn, where are you starting from? I got to know the facts. Where are you today and how do you want to get here and how soon do you need to get here? You could walk, you could drive, you could fly a plane, you could do it virtually. So we got to find what's the speed at which you need to move forward. And I have found it much more effective to not lead with a solution to a problem that doesn't yet exist. I want to identify, where are you starting from? What are the facts? Not opinions. What are the facts? How will your money behave in the future? And what are the costs, the planned losses, the costs, the taxes, the fees, the interest to other institutions, inflation, liquidity that you're going to experience to play the game, to put the money into your financial life? What's that going to cost you? And when things go right, what are those costs? Then we need to find a way to protect when things go wrong. If you get sued, if you get disabled, if somebody dies early, if there's a big technological change that really speeds things up or really shuts things down. We experienced a lot of that during COVID. What if the markets, not just the markets of investing change, what if the markets of borrowing change? So, during COVID, a lot of people before COVID were looking at very low interest rates and they were on mortgages and they were doing a lot of home equity loans and refinancing. And then when COVID hit, 3 of the largest banks in the world shut down the ability to do home equity loans. People just found out that their home's not really an asset. Equity is not necessarily an asset. Now, investment property might be because it's paying you something. But if it's your own home, it may not be an asset at all. It may be a liability. The next thing that we learned was I owned a lot of property in 2005, 6, 7, 8. That was tough.
Yeah.
I had 128 properties. And things were going really well for a period of time. And then one day they weren't. Not even had been late on a mortgage ever during that time. We had mortgages called because the repricing of property, they thought the appraisal market was off. So the banks changed the appraisal concern so that they then could raise dollars. And then the federal government went and bailed out the banks that were in trouble. Now, I really don't understand how banks get in trouble anyway, because they're not using any of their own money. It's always everybody else's money. So if dollars on demand aren't available, we have a problem. Markets change. So what I've learned was the ability to move quickly and have access to capital is extremely important. Extremely important. What I also learned is chasing a rate of return usually doesn't help you win, because rates of returns do not pay bills. Cash does. We have to create cash flow to the consumer, not just away from the consumer. I'm 62 this year. I would prefer to get at the point in my life where I slow down, and I don't know when that will be. I hope I don't find that day, but because I love what I do. And what I have learned is when I get to that age, I want to be the person who can choose to be in the highest tax bracket, take the highest income, but pay the least amount of tax, as opposed to being forced to receive income that's required minimum distributions, live a lesser life because I don't want to pay the tax. And somebody sold me earlier that I would position my assets and put all my taxes off till later. I've never seen a problem get better by waiting to solve it. It just festers, right?
I love it. And I think as you're talking, I'm just thinking about, the things that we're really trying to promote is really like, we don't want to retire. We want to build the life we want to live, and also, be comfortable in the situation. Thankfully, don't have to watch the news to find out the next decision we got to make. It doesn't really matter. Like when I'm watching things on the news, I'm just like, man, I'm glad I don't have to worry about this.
That's right. That's right. It's hard for you. You don't want to have to, it's not hard for you. You don't want to have to make it hard to worry about that, but it's even harder when you have to look at other people who are experienced that are clients of yours.
Yeah.
So I have a lot of clients who are older than me. And when they retired, before they came to me, they were really frustrated and scared because they had a moment in time where their retirement accounts dropped by 30 or 40% in just hours. And an income that they were relying on for maybe the next 20 years of their life will not last if they continue to take the same income. So we had to find ways to free up money, we'll start with a safer component and then build back through the velocity of money multiplier to be able to recover dollars. And that helped them through safety and certainty to know that they won't run out of money, both when things go right and when things go wrong. That's very comforting, both for me as a coach or an advisor. I don't sell anything today. I work with advisors who do. I do a lot of their meetings with them to be an economist, if you will, and help train the personal economy of how people align their money and the strategies. And so when we walk through that process, we're just watching people's faces change about finally understanding how their own money could have worked and now can work. It's very fulfilling for me to be able to be a part of that.
Hey guys, if you'd like to learn more about the infinite banking concept and how to flow your capital through your own financing system, my team and I are here to help. With over 35 years of experience, we can guide you in building a properly structured whole life policy tailored to you and your family. See the scheduling link below. Now, back to the show. I think the best way for me to get my mind wrapped around it was to think of the end in mind and then back my way into it is really how it worked. And it's like, I think the real regrets happen, if you're like 80 years old and you just realize like you can't backpedal at that age. You're already there. So it turns into like, how do I want to be? Do I want to be comfortable? I've talked to a few people just retired recently, and they're trying to figure out how to unwind their current portfolio and really tied up in stocks and 401ks and really, it's like they're really dodging the tax man. That's how their plan is. And they weren't planning that. It's like they created this problem for themselves because they funded, like I was funding for 5 years straight, fully maxing out my income or my retirement funds, and realized I felt broke all the time. Like I had no money left. I felt like if my job fired me, it was going to be where I would have had to get myself into a worse situation with like, cashing out your 401k, you're taxed with 40% when you don't have any money. you know? It's like, oh, you don't have any money, you're going to cash out your 401k, and we're going to hit you over the head with this big tax bill with showing that you made more money this year than you've ever made because you cashed out your 401k. Or, you're just trying to, it's the whole system with this qualified retirement plans is just really, I think it's just a limiting. And the other thing that comes with it is it's the inner dialogue that I'm telling myself, give my money to somebody else so they can manage it better than I can. And also I'm going to make less in the future. So I think it's like a self-fulfilling prophecy that ends up happening. It's like, I'm putting my money into this place to make less money and hopefully my tax rate's lower in the future. It's like, why would I plan that way? It's like, that's really what I was as I was trying to figure this out.
That's a good step to go through. I'm going to make a statement and then I'm going to follow up with something here. But the statement is I'm actually not against any financial products. They are what they are.
Yeah.
Okay. So when you make a decision about how you're going to utilize those tools in your life, you need to know what it costs to be in them, what the upside is, what the exit strategy is before you start, what it costs to transition from a statement on paper to real dollars in your pocket. There's a cost to that. And then we need to know, if I'm putting money in this specific product, whatever it is it costing me money someplace else? The carrying cost of that decision. Am I also forfeiting the use, the decisions, the opportunities that could come to me if I've put my money in places that lock me out of it? You're not necessarily locked out of a retirement plan if you want it early, but there's ways to get it. So some companies have something called the in-service withdrawal. Not all companies have that. Some companies, for you to get your retirement plan, you have to terminate your employment to get it. When you do, if you're younger than 59 and a half, then you'll pay a penalty and a tax. That's that 40-something%, so 50-something if you're in certain states, that it could cost you. It doesn't say you can't do it. It just says there's a cost of doing it, right? So what are the levels of control you forfeit depending on where you live, where you work, what you invest in? Now, what you said, what a lot of people are trying to dodge the tax man. What I try to teach is, there's 3 stories here if we got a little time. So one is, if I'm let's say you and I are partners and you got the skill set to go work, you know what you want to do, and you can make all the decisions on how we're going to earn money. And what I'm going to ask you to do as my partner is, I want you to invest money in this business and work real hard, and I'll do my best to cheer you on, and I'll help protect your money, our money, along the way. But at the end, I'm going to tell you what portion I want.
Yikes. That don't work.
You wouldn't play that game if that's the way it was described to you. And by the way, if I want to change the rules of how much goes in there, whether you can have it or not, I can do that. That would make it worse, wouldn't it?
No. Yeah, I know.
That is what most people are playing, blindly having faith that the government's going to take care of them. People that tell me that, I say, how responsible do you think the government is with your money that you do give them? And nobody says very responsible.
Not a concern.
Yeah. So what we want to do is, it needs to be our money. Here's the other thing, that it does not save you any taxes. Zero.
None.
The tax rate does not have to change for it to cost you more than it costs today. And the reason that's true is, today, if I get paid, I have my money after I've paid the government a known tax. If I earn $10,000, I'm in a 20% tax bracket, and I pay them $2,000. My portion is $8,000. I can do whatever I want. They only get $2,000 in this year. If I forfeit my $10,000 today and say I want it later, 30 years from now, and I put my $10,000 into a qualified retirement plan, now my plan portion at $8,000 will grow with whatever earnings I get, but so will theirs. Their portion of $2,000 is going to grow at whatever the return is. Just because of that alone, I'm going to give them a lot more money, because the government is now getting the benefit of the growth that I received during that time frame. It doesn't matter if tax rates go up. So what people are forced into when they get to the end, after having left it there, did everything everyone said, may even had a match. As the money goes in there, when it's time to take it out, they don't choose to take lump sums because they don't want to pay all the tax at once. So they think that if they take it over a longer period of time, which is going to be somewhere between 7 years to 13 years on average, because that's about how long retirees live after they've worked somewhere for a while. They choose they're going to take it over a long time, and then time is shortened, what happens if they lived a long life, they end up paying more in income tax than they would have had they taken in a lump sum because it continues to grow. The other thing that happens is they choose to take an income before they know the return and before they know the tax rate. And if things don't work out, now they got some serious life decisions to make. If they haven't protected that decision, or if they haven't created a strategy early on in what we call the mid-game of life, then they have zero creativity late in life. What we want to have happen is to have strategies where, okay, if I did put money in a retirement plan, when it's time to take it, I don't want to have to pay all of the tax and sometimes any of the tax.
Can you just zero creativity? What does that mean?
Zero creativity means that it's like a game of chess. In a game of chess, you have 3 phases of the game. You have an open game. In an open move in chess, you only have 1 or 2 pieces on the board you can move. Very limited options, very limited number of spaces. There's the mid game. That's a time period where you get to be creative and strategic and move your pieces, hopefully to the advantage of winning. And then there's the end game, when you only have a few pieces left and you're trying your best to protect your king. When you are at a financial life, there are 3 phases of the financial game. The open, which is like the accumulation phase of life. That's where people are going to work, starting families or starting jobs, trying to figure out where do I put the money. At first, there's not a lot of options, right? You got to earn the money first, can't take a lot of risk.
Yep.
Then there is distribution phase. That's closer to retirement, maybe retirement. That's when your assets are going to pay you an income for the rest of your life. For some of us, that can be a lot earlier than retirement. I don't like the word retirement, by the way.
Yeah, I understand.
Retirement means to take out of service. I'm not living a life to be out of service. I think the better I do, the more involved I'm in, the more impact I can make, the more service I should give. Then the final phase is called preservation phase. This is where we face the fact that we all live until we don't. We should face it early, knowing there's an end game, so that we can prepare to live the life we want those last 20 years. But most people don't. They wait till they get there to make that decision. Preservation also has to do with how much of my current estate value can I pass on to my next generation. One of the worst things in the world to pass on to the next generation are qualified retirement plans. It used to be a good thing. Now it's a bad thing. The reason it's a bad thing is they're forced to take it in 10 years. You might say, well, that's great. I got this big money coming in 10 years.
Even the Roth, correct?
Yes. The Roth impacts it a little differently because it still comes in tax-free.
Yeah.
Not the qualified retirement plan. It comes in as a taxed asset. So whatever earnings they already had before the inheritance, it's very likely that they're now going to be in a much higher tax bracket that makes all their money more ineffective. If I'm going to receive something, if the simple question is, Glenn, if you're going to inherit money today from anybody, would you prefer that it comes with a tax bill or without one?
Prior? Like I know what the tax bill is?
Either one. Say, here's the choice. I'm leaving you money. For some reason, you're my beneficiary.
Yep.
And you're going to inherit everything I've got. Do you want it to come with a tax bill or without one?
Oh, definitely without. Sorry, I misunderstood.
And my questions, sometimes people miss them because they are so simple.
Yeah.
Because people try to get creative and think around it. I want simple. Here's some simple questions. When you plan to get to the point in life where it's time to take income, would you prefer to have the most income or the least?
I would want the most.
Yeah, the most. Would you prefer to have the most tax or the least tax?
The least taxed.
Would you prefer to have the most freedom or the least freedom?
The most freedom.
I always have to ask people, what path are you on right now? Based on your current financial position, what path are you on right now?
It's a question I had to ask myself. That's when I changed. I learned that I was on the wrong path. It took me a lot of brain damage to figure that out. So real quick, as you're talking, I didn't want to interrupt, but there was one thing you talked about the early distribution. And it seemed like I didn't sound like the conventional way of distribution from what I understand the distribution. But when you said some people take distribution earlier, what does that mean?
Prior to age 60.
Okay.
Yeah.
Yeah, because I was thinking as you were talking that it's like, for me, I focus on cash flow assets. Obviously, I take loans against my policy, put them into cash flow assets, the cash flow flows back in. And I think that for me, that's how I diversify my own income, because if ideally I don't need the cash flow, but at the same time, if my personal income lowers, then I can have this additional cash flow. So that's what I thought about when you were saying distribution.
Yeah. there's 2 or 3 ways to receive a distribution. Distribution that most people think of is, okay, I'm turning an asset that I didn't have an income from before. I'm turning an income on from that asset now. That might be a retirement account.
Mm-hmm.
That's the most costly because you have taxes and you might have penalties if you get it early. You also have, during the accumulation, you'll have fees on the money as it grows. There is non-qualified money, meaning it's not in a retirement plan, but it's an asset that you own outside. That could be your own business. That could be hard metals. It could be real estate. It could be investments that just aren't in, it could be the very same portfolio, just not in a qualified plan. In those, there's no restrictions on when and how you get your money if they're not wrapped in an IRA of some type. So what we look for is, when do you take on money? What the typical plan says is you're going to work and work and work. You're going to budget. You might work for yourself. You might work for somebody else. You're going to budget so you don't overspend, is what people fear, that may get in debt that's uncontrollable. That's most of America. Not everyone, but most of America. Maybe not you and the people you're working with. But when they get to retirement, the time they quit working to create an income, no more physical hours. There's a transition they have to go through. They've had a check forever. And now they get to retirement and they have maybe Social Security. Some people might get a pension, not many. And then I have to turn on these assets to pay me. They have no experience at managing the market, so they're still living in a world where someone else is managing and controlling their money. Not against management of money. I'm very much against confiscation. They start to take those dollars, and now there's a lot of fear. They have to now have a very precise budget if they have a low income, because if markets come down and they keep taking the same income, then they'll run out of money before they run out of life. If the tax rates go up and the markets come down, at the same time they're disinvesting from the market. If they don't have assets outside of that market portfolio, they will run out of money even faster. So it's exceptionally important, I think, to not only have we call it non-correlated assets that are not in the market, like cash value and equity and other properties.
Yep.
But that you can access quickly if needed, or take a whole year's worth of income so you don't have to withdraw from that portfolio. Add life to the portfolio by not withdrawing after a loss. What I've experienced, though, is I don't want to wait till 60, 62, 65 to transition. I want to build cash flowing assets, which our family has done over years, when we're 35, 40, 45, so that we have multiple options that could pay us, so that we're not making a transition. We're not saying, okay, now at 60 and 65, I have to understand all this, when my mental capacity might not be what it was when I was 35 and 45. I see that now. I heard that all my life growing up, right? So now I'm in my 60s and I'm seeing people in their 70s and 80s, people who are having dementia, and how sugar impacts their life, and their memory's going and their trust factor's going, and they don't know where things are at. So what I'm learning is emotions also impact the markets. The biggest risk to investment world is not the market, it's the emotions attached to the market.
100%.
Also loneliness. People who have worked with a lot of people for years and one day they don't. They've changed their routines. They're not with the people they have been with every day for the last 30 years, 20 years. Loneliness sets in. That's a huge risk. Depression sets in. That's a huge risk. We want people, this is why I say I don't like retirement. We want people to be prepared to be of greater service.
Yep.
We want them to have a purpose. We want to direct them to a much bigger vision from today until age 85, age 90, whatever that is. The reason we want to do that, think of the people, Glenn, you might be too young to even experience this yet, but think of the people who you may hear say, if I knew I was going to live this long, I'd have taken a lot better care of myself. At my age, I hear a lot of that.
Yeah.
I also hear a lot of people say, man, I sure wish I had that permanent insurance.
Yep.
I heard people say that would happen when I was in the business at 25, 30.
Yep.
Didn't mean anything to me then. Now I'm in my 60s looking at people older than me saying, they're coming to me, can I get life insurance? Can I get for the death benefit, not just the cash value, the death benefit?
You have to experience, not like you dying, but seeing other people struggle through it to realize how important it is. That's kind of what happened to me when I started getting really into IBC. I was low liquidity, and then also watching two people over 80 years old die, and the spouses' lives changed after that. And you would think at 80 years old that person should be fine. They're fine at 80. And it's like, they just lost some income. They had to change their lives. They had to move. They had to consolidate their life because of it. And I watched that happen. And then also just through life lessons of business. And that's really where infinite banking concept really improved my financial system.
Yep.
When I was hearing you talk, it was like a great conversation with this kid that's 23 years old, trying to figure it out. And I said, when do you want to learn about, to be an expert at something, you can't start like 10 years from now. We have to start now to get to that 10 years. So it's like, if you want to hand your money over or whatever, I'm anti handing your money over. So I mean, I know that might change over time, but I think that we have a better life to live. And at 23 years old, let's figure it out. Let's figure out how to regain control of your financial situation. And I was like, do you want to learn this in 10 years from now, or do you want to learn it now? Do you want to hand off your money to somebody else, or do you want to find out how to use your own capital to earn some income? And then what happens is people get to the ages of 50 or 60, and then they figure out how are they going to withdraw, or how do they create a distribution process for themselves, and then they get interested. So it's like, how do we figure out how to start today, make mistakes to learn what not to do in the future, instead of making those mistakes when you're 50 and 60 years old, trying to figure out like how you're going to recover from that,
It's tough. It's tough. I've seen a lot of people have to recover. Divorce, that injury.
I've seen it too.
So let me put a thought in your mind. Let's say that everything in life goes okay for somebody. No major problems. We all hear about this, been misinterpreted, but we have heard about the compounding of interest and how great that is. Somebody said that Einstein said it was the eighth wonder of the world. It's not actually what he said. He said the compounding of numbers is the eighth wonder of the world. What has happened because of marketing, we have found that people are putting money into strategies to compound for their entire life. When you are compounding your money, you are not touching your money. You're not touching the earnings. You're not touching anything. But in the world of compounding, the major growth is if we live 60 years, the major growth is in the last 10 to 15 years. So if I take off 5 years, 10 years of starting to learn to put money at work, it doesn't cost me a whole lot in those first 10 years. It cost me an enormous amount in those last 10 years. Millions of dollars, literally millions of dollars. We're going to manage money for about 60 years of life. That's from the time we start working to the end of our life. If we position things appropriately and we do well, then we're going to have an influence beyond us that could go to children or grandchildren, great-grandchildren. That could go to start hospitals and schools and charities, lots of things it could do. And everybody has that opportunity. Everybody, even technically people in poverty, could save enough money to be a millionaire at retirement without taking big risks. Little dollars. Now, you have to have some compounding, but compounding and accumulation theories is not what gets you there. You have to protect it. And that's what we were talking about earlier. You got to protect it from the things that are attacking that money so that you don't get interrupted in the compounding phase, so that you have access to dollars. Things that there's planned losses, there's taxes, that's a planned loss. There's fees on your money at banks and management of money in the investment world. There's fees for transacting your money, for moving it from one place to another. There are fees for owning something like property tax. If you get a lot of real estate, you're going to be paying property tax.
Yep. Yeah.
And like you think about all the technology we have today, I might buy a big, huge screen monitor here for $1,000 and think I got a great deal. But for the next 5 years, I might pay close to $350 a year for the next 3 to 5 years for the services that go with that, for the channel, for the updates.
Yep.
That's technological change. That takes money away from you. Lifestyle creep takes money away from you. As you earn more money, you tend to raise your expenses to keep up with it. Most people do. I'm not saying you specifically, but most people do. As if they want something to happen right now and they don't have the money, or they can't access their money, or they don't get permission to have their money back because they were denied for some reason, then they have to go borrow from a higher risk, higher interest rate. Now they're going to cost themselves future wealth to pledge future income for something they want today that they may not have tomorrow, like cars and credit cards and personal loans. Those things happen. That takes away from your wealth.
Yep.
And when they buy things that never give them a recovery, term insurance is one of those. Term insurance is fantastic for a short-term protection component. Fantastic. But it's meant for short-term.
Yeah.
But a lot of people have followed this advice of buy term insurance, keep it until retirement. When your debts are paid off, kids are gone, you no longer need it. And so that it either expires or they cancel it. Well, they just put all the pressure on their assets now. So the day before that expires, let's say it was a $5 million death benefit, and they have $5 million worth of assets. The day before it expired, their total estate was $10 million. But by design, tomorrow, it's going to be $5 million. Do you make those kind of decisions on anything else? Self-insures means you're going to limit the amount of income you can take off the $5 million because it has to do everything. And now you can't touch it. If the death benefit, if you could cancel the premium and the death benefit remain, then your retirement income could be, if it's 4% on $5 million, that's $200,000, that's the 4% rule. But I could do a pay down strategy on the full $5 million for the next 10 to 15 years, pay it down to zero, spend it all if I lived 15 years. The reason I could do that is, and my income goes from $200,000 to about $350,000. Now I have freedom. And if I die in the next 15 years, I got a death benefit that replaces everything I enjoyed for the people we lived behind. Infinite banking, we were taught mostly to talk about the cash value. Access it, borrow against it to go create a new asset. It's a phenomenal tool when you do that and you pay it back and you follow the rules and principles of infinite banking.
Yeah.
There are too many advisors in the industry. I can say this looking back from experience. I've coached thousands of advisors over this 37 years time. There are too many advisors who are real excited about this is, a great tool. Let's put a lot of money in here. Let's borrow against it for everything, for paying your bills, for
Yeah.
And when that happens, they forget the part about paying it back. Policy won't lapse because you don't pay loan interest back and loan back. It will lapse because you don't also pay the premiums and you've borrowed everything out of it. And so if it happens and the agent is not on top of being a servicing opportunity for their clients who helps them, makes the decisions, helps them follow through in the process, then you'll have people who had good protection for a while and then they too end up with nothing if they don't follow the rules. What I learned through that process with Nelson is that, I should say Mr. Nelson Nash. I literally love the guy. We spent a lot of time together.
Yeah.
What we learned there was he said when you get to the later years, the death benefit there becomes real important. You've built the cash and the death benefit's going to be equal to or greater than the cash when you get later. And that gives you the freedom on those other assets that you built. If you wanted to, you could give them away. You could give your business away if you had enough death benefit. You could not sell it at a fire sale. You could donate it. You could give it to a charitable trust. You could give your shares of ownership. I teach this a lot. You could give your shares of your business, your stock value, before you sell it, gift it to a charitable remainder trust, have the trust sell it. Now you have a deduction for the gift, if you have the right words in the trust, off the fair market value of the gift, not a reduced portion. You sell it, all the cash now is in the trust. The trust pays you an income for the rest of your life for you and your whoever you're sharing life with. And if you have a life insurance policy with death benefit, you just allowed your family to receive the gift you gave away when life's over. If you don't have the death benefit, then you're disinheriting someone for the amount of money that now is going to charities and other beneficiaries. If I have a huge deduction, isn't that a great time to go take my lump sum from my retirement plan?
Oh, yeah.
So you control the timing.
Yep.
When the policy is there, you get to control what's taxable, when it's taxed, and if it's taxed. Life insurance gives you that permission. So it's not a single product versus everything else.
Yep.
It's the turbocharger on everything else that makes everything work better over your entire life because of all the different features of life insurance. Life insurance is one of the few assets that does more than one job at the same time. It accumulates cash. It pays income, dividends. You get to choose what you do with dividends, earnings.
Yep. You
can borrow against it. It gives you accelerated death benefits in the event of long-term care or terminal illness or a chronic illness. There's money accessible. If you're disabled along the way and you had waiver premium on your deposits, an insurance company will fund it just as if you would have all the way until the end of whatever the contract says. And you still retain all the rights of the contract. So if I have a rental property income paying the life insurance premiums for me and I get disabled, my family gets to keep the rent. The insurance company pays the premiums. I get to access the cash. Now I have twice the cash flow in the event of disability, not half. You got to learn how to, position where all the assets coordinate, integrate to give you the best advantage.
Yeah.
That's the mid game I'm telling you about in life.
That's awesome. It's literally like hard to believe. that that it's all come together. But we're kind of running out of time. I'm excited to meet you in person. I believe I'm going to be at some conferences soon where you'll be. I think Better Wealth, I'll be there. And then I think, are you speaking at Better Wealth?
I am. Yes, sir.
Yeah, I'm excited to see that. And where can people find you?
Best way to find me is probably my website. It's my name, trentfortner.com. If you're an advisor and you would like to talk further about how to, enroll in some of our programs, I'll be glad to talk to you. If you're a client, a consumer client, they should come to you in this conversation.
Yeah. And thanks for being on the show.
I'm honored. I'm sorry I talked too much today.
No, it was great. I enjoyed it all.
Thank you. Look forward to however I can help you. So thanks for having me.
Thank you for listening to the Capitalizing Your Life podcast. Please rate, like, subscribe, leave a comment, and share with someone who you think would enjoy listening.